Welcome to Session 4, Budgeting. At the core of budgeting is our agreement on exactly how our resources will be used to achieve future strategic and operational plans. And core to this is our ability to accurately forecast future income as well as the cost of each program or service we deliver. Because without this full picture, we will only ever be able to assess the current solvency and viability of our organisations, rather than budgeting and planning for our future sustainability. We're going to be having a look at slide 29, 31 and 32 to get a general understanding of what this means and what budgeting options we have within our organisations. If we start by looking at slide 29, we're forecasting future costs. There are many bases on which we can start to or use to forecast our future costs. The most popular one that we tend to use is our year-to-date last year, so our actual cost figures from last year, plus any markups that we may want to put forward, such as known changes, wages, salaries, or just general CPI, into our costs for this year. The general accountancy rule of thumb tends to be, everything that happened last year plus 10%, because that's the way the dollar tends to and prices tend to increase. What we do need to remember though is that by forecasting in this method can be just considered a slight bit lazy, because all we're doing is attributing next year's costs to last year's historic evidence, and it doesn't really take into consideration any bigger picture. To really budget and forecast for our future costs, we can use this as a basic rule of thumb, but we should be looking at all of the key costs centres of our organisation and having robust discussions between our senior management, our frontline staff and also our board in regards to not only what's happening within our organisation, what we might be investing in the future, but also the changes and known changes that we know are happening in the environment around us. One of the stories that I've heard before is that if we average our increase of cost and just throw a random number in there of 10%, it's a bit like creating, an average. If you put 1 foot in a cold bucket of water and 1 foot in a hot bucket of water, it doesn't mean that you're going to be consistently warm. All it means is you're going to have 1 frozen foot and 1 burnt one. So what we can do, and what you can have a look at in your workbooks, is going through a concept called risk-adjusted scenarios or risk-adjusted costing. Now, this does not only take into consideration a percentage increase in the cost, but also the known and valued views of all other people within your organisation. I'm not going to go through that particular exercise today, but please do have a look at it in your workbooks. There's a great exercise and one that really just looks at a future projection of income, for example, on a program, and quite clearly explains how you can work through that as an organisation. The other thing that I want to have to discuss before we start looking at another budgeting scenario is the idea that there is the relationship between cost and volume, and this is a really important thing to remember as well. Just like we had a look at in session 3 around the sensitivity analysis, where we said that of course as soon as the volume of our service goes up, variable costs go up as well. And to be able to have a really good understanding of the difference between fixed and variable costs in our organisation really allows us to understand how our costs increase in accordance with our increase in volume. Sometimes we are actually working at a maximum capacity where any further increase in volumes means a total restructure for the organisation, and this is not necessarily cost effective. On the other hand, sometimes we're looking at scenarios where our programs absorb so much fixed cost that they're actually working at a loss no matter what number of hours, clients or services we can throw at it. So we really need to ensure that we have an equal and fair proportion of fixed and variable costs within our program delivery. One trick of the trade for any organisation that may be facing solvency or viability issues is to decrease the fixed costs and increase the variable costs. So what that means is we've got the greater costs, but only once we are actually delivering units. The flip side of this, of course, is that it's not always a sustainable strategy to do that, because if we need to get rid of fixed costs, basically our staff, we often put ourselves and our organisation into a scenario that we can't necessarily react fast enough to deliver the services when they come on board. So do have a think about your fixed and your variable costs and how they work together to be able to create your service delivery, and make sure that there is what you would consider a fair balance, and we will have a look at this in just a minute. But first, what I want to consider is slide 31, and if we go to 31 now, it gives you an example of an operating budget and what we need to really have for an organisation to not only be able to look at the budget and assess, are we doing okay, but are we also going to be okay in the future? So this operational budget actually gives us one historical evidence for us to work from. So in this case, it's the actual figures for the last 2 operational years. It gives us our total budget for the current year, and then it actually breaks that down into quarters. So not only are we looking at it from a budgetary point of view, but it allows us to start to consider what our key expenses are from a cash flow point of view. If we can have an understanding of exactly what our costs are from a quarterly basis, we can start managing our costs and our income in accordance with that. The reason why we look at quarters for not-for-profit organisations and not months is because we tend, under the government grant system, to be paid quarterly. So we're wanting to be matching our outgoings and expenses with our income. Again, we tend to call this an income and expenditure budget rather than a profit and loss statement, but it will marry directly to your profit and loss statement within either MYOB or QuickBooks or whatever the system is that you're using. If we look down through this example, we have broken up the different programs and we are starting to allocate our income to those individual programs. And that's really important for us to start doing if we're ever going to be apportioning costs back against those individual programs. Then if we have a look at our expenditure underneath that, we have a look at different things such as our audit fees, equipment, client support services, consumables, insurance, motor vehicles and salaries and wages. We can quickly go through that now and actually be able to apportion that to whether or not it's a direct service cost or an indirect service cost. And while this is an operating budget for the organisation as a whole, we can use this as a direct template to also deliver program budgets, and it's a really good tool to pass on to managers where they can be thinking directly about their income and their direct expenses and give them a real sense of understanding in regards to how their surpluses or what surpluses they're bringing into the overall organisation. On the next slide, slide 31, we look at a different type of budget, but one that is certainly more important for those organisations that have large capital expenditure, mortgages, or business loans. Cash flow is different from an operational budget because it doesn't only consider the direct income and direct expenses that we need to pay on a day-to-day basis for our organisations to continue delivering our services, but it also includes the other outgoings and incomings that we may have through any capital investments or capital loans. And in most cases for us, that would be our mortgages that we have if we've purchased buildings. So this gives us a truer sense of our overall cash flow because it also considers all of those organisational situations. and it certainly would be the recommended budget for any organisation as soon as you have a capital expense or a capital income. I recently was asked a question in a workshop that said, even if we're preparing to purchase a building in the future, should a cash flow budget be one that we should be considering? And what it does do, by starting one now, even though you've got nothing coming in and nothing going out, it does allow you to start playing with cash flow scenarios. At the bottom of each of the quarter, we'll see what our closing bank balance should be, and what we can do is ascertain the difference between that at an operational level and whether or not we would be able to sufficiently finance a loan. One of the key things banks ask organisations at time of getting loan is not necessarily only of what it's going to be invested in, but whether or not we have the cash flow to be able to support that ongoing expense. And this is one way of being able to budget our past and our future in regards to being able to meet those changing cash flow expectations. Now if we can all go to slide 36, it actually provides an example of what we can do with all of our budget, fixed, variable cost information, and what we can do to work out whether or not programs are going to be in surplus or in deficit, and where our break-even points are actually going to be. We can use this in conjunction with our sensitivity analysis to give us break-even points and break-point scenarios, not only for individual programs, but for our organisation as a whole. And when I'm asked to go in and audit organisations in regards to their financial viability and sustainability, this is certainly one of the most common tools we use, because it gives us a very visual explanation as to where we sit within an organisation. The most important thing is that we need to equally attribute our hours to our dollars. So if we have a look at the graph on the left-hand side of the slide, we have example label hours of 1,500, and we have an example income of $476,050, which we took from the 2014 example of the sensitivity analysis. Why 1,500 hours, people do ask, but 1,500 hours is actually the average labour hour of a full-time worker in 1 year. So this suggests we want to know is how much that employee needs to work to be able to create a break-even point for this program. So if we've got a little table on the next slide as well, and what we've done there is we've taken all of our expenses from the previous chart and we've broken that into our fixed and variable costs. So those costs that we know we have to pay whether or not we do even 1 hour of service, to those costs that will actually fluctuate depending on exactly how many hours of services we deliver. So if we draw a fixed cost line at $196,300, we can see that it doesn't change, and it's a constant line across the graph. From the fixed cost, we have an additional variable cost of $179,000 to give us a total cost of $375,306 to be exact. What we do is we join the variable cost to the end point of the fixed cost line. So you will see that on the axis, on the left-hand axis at $190,000, we have our total cost line, which goes up to the difference between the fixed and the variable costs. Now, because we're government funded agencies and we tend to get our income at a consistent and regular basis, we all laugh when we hear that, we actually have a consistent income line. So we start at 0 at no hours, and if we deliver all 15,000 of our hours, we will receive our full income of $476,050. So our line draws straight through the middle. Now our break-even point is where our income intersects our total cost line. And in this case scenario, That is just under 10,000 hours and just around $300,000. So we know while we have the opportunity to earn $476,000, we actually only need to earn $300,000 and deliver 10,000 hours of service to break even for that program. If we look at that from a ratio or proportionate basis, this means that we've got about 65 to 70% of the service we must deliver before we break even, and the further 30% of delivery ends up being our opportunity to earn surplus. And in most circumstances, this would be correct for the majority of our programs. In some cases, we may have programs that sit more around the 80-20, and in some circumstances even the 95% before we can even break even just the smallest amount and gain the smallest amount of surplus. But this is the nature of our organisations, and this is why it's very important that we look at programs individually, but when assessing our sustainability, we look at the programs and how the organisation works together as a whole. And coming back to that, the most important factor for us to think about when we're looking at our organisational sustainability is not always about the price and the cost, but actually how our organisations continue to support and work towards the purpose, as well as the mission and vision, and ensure that we have ongoing value, and that can be through reputation and through demand within our communities. So I hope you've enjoyed all 4 of the sessions presented by CSA around the concept and the module of costing, pricing and budgeting for not-for-profit organisations. If you go online and have a look at all of the other resources available to Module 1, you'll find that there is a workbook and a PowerPoint on this subject, as well as the direct tools that I mentioned in all of these presentations today. But if you're struggling with any of the concepts at all, I've also uploaded a workbook on financial literacy and also a workbook on organisational viability and sustainability for you to review and use within your organisations. So again, I hope you've got some real value out of the sessions that we've presented to you, and I hope that they are supporting you in regards to your work through the Organisational Toolkit by NDS. And not only does it help you today, but for all of the future ways and future circumstances that the sector may be heading.